Some of the most influential myths are difficult to distinguish from reality because they seem true on the face of them or they are close to the truth. Here is an example. A mother asked her son if he finished his homework. He responded, "I have completed exercise 2." This statement may be accurate, but it doesn't answer the question about the completion of homework. The son could have still misled his mother even with a truthful statement, as this exercise 2 could only be a part of the homework. Such is the case with persuasive investment myths as well. With so many moving parts and unpredictable possibilities, it is very easy to fall prey to investment myths. These myths and misconceptions often confuse investors and prompt them to take some absurd financial decision. Thus, knowing the difference between investment myths and reality can be your ticket to become a successful investor. Hey guys, John here, not an analyst. Welcome back to my channel. In this video, I will share with you the 4 biggest myths about stock investing that you should avoid. Myth number 1. Invest in high dividend yield stocks. The biggest misconception of dividend stocks is that a high yield is always a good thing. Many dividend investors simply choose a collection of the highest dividend paying stock and hope for the best. For a number of reasons, this is not always a good idea. Why? To give you a perspective, since 2009, many investors have piled into dividend-paying stocks, many of which have yields of 5% or higher. They were attracted to those companies because it was hard to make money in bonds thanks to low yields. I'm referring to the 10 years US Treasury yield. And overall, portfolio returns were low too. This is true till this day with yields falling consistently. Similar application to our Malaysian bond, but at least it is still juggling around 4%. Unfortunately, those who only look at yield will suffer if those yields were suddenly cut by the company. To understand dividend yield better, you need to understand the formula behind it. Dividend yield is derived from its dividend per share over the company's share price. A higher dividend yield could be obtained when the company's dividend per share is higher, a drop in share price, or both occurring at the same time. A classic example is British American Tobacco, ticker symbol BAT. Although its yield looks pretty neat, with the highest yield in the early 2020 at over 10% of dividend yield, but when looking at its historical distribution dividend per share, it has been falling for 6 consecutive years since 2016. What's even interesting is that BAT's share price has also fell quite substantially over the years. Besides BAT, there are quite a number of companies that are having high yields but inconsistent and dropping dividend payout. To name a few, Pentec, Taliwork, and even Astro. Instead of looking at dividend yields, the right way to invest for dividend income is to look for companies that has been consistently or even better increasing their dividends year after year. It should be a red flag if dividend cents per share is not increasing because it shows that the company's lack of commitment in rewarding shareholders, or simply they are not growing. How can we tell if the company has the ability to distribute dividend consistently is by understanding their nature of business and commitment in paying dividends. If its business is prone to external risks like the global financial crisis, US-China trade war, the COVID-19 pandemic, essentially unexpected events that can affect the business demand, then you may expect a major slash in payout. In contrast, you want to look for companies that have a strong moat, basically a proven track record of surviving during those events, plus are highly committed to reward their shareholders. Financially, companies' historical growth of free cash flow and retained earnings, or what we call it as reserves, can give investors a better insight on the company's sustainability in paying dividends as they are generally distributed from there. Some companies that have a track record of paying dividends consistently are Nestle, F&N, Ajinomoto, Hong Leong Industry, and the list goes on. So make sure to do your own research. Myth number 2. Only invest in low PE stocks. When investors search for undervalued companies, they often hone in on an operations price to earnings ratio. That measure, called PE, represents the price people are willing to spend on a business for every dollars of earnings it generates. In hindsight, it tells us how long will it take for an investor to recoup back his or her capital. If investors expect strong future growth, they will pay more. If it looks like earnings will only expand slowly or not at all, investors will pay less. It's a metric touted by investors and fund managers all over the world. While PE is a good starting point, it is dangerous to base a buy on that ratio alone. In some cases, a one-off event may cause that PE to fall in the short term, making the stock appear cheap. For example, the glove companies like Top Glove and Supermax, although they have a strong boost in quarterly earnings which resulted their PE to decline lower than its historical benchmark, the stock price doesn't budge and fell miserably. This shows that most investors may already expected the good earnings and doesn't really attract many investors to pay more despite its low PE. That being said, the glove companies need to report extraordinary earnings, beating analysts' expectation in order to attract more investors' attention in buying the stocks. So how does one avoid falling into this trap hole? Here's a simple step-by-step guide in using PE ratio the right way. Step 1. It is the most crucial step before we even look at the PE ratio is to understand what problem the company is trying to solve and if the demand for their product and services is still much needed for the long term. If you know the answer to those questions and you believe that their business is still very much needed, then you can proceed to step 2, which you want to do two comparisons. Comparing its historical PEs for the past years, let's say 10 to 20 years, and also to rank the current PE with its peers in the industry. It's important for investors to do such comparison because it tells us the company's average valuation and whether it is within the industry's valuation. The last step may be a little bit more advanced, but very useful to project the company's valuation to its future earnings, and that is the forward PE. Most analysts rely heavily on the forward PE measure. As the saying goes, the stock market is always forward-looking. That being said, it's a lot more important to know what things will look like in the future. Ultimately, if the PE is trading lower than average or than its peers, then it is a good indication that the stock is undervalued. Some may ask, how do we value a company if it is trading at a negative PE? Well, now all of a sudden the PE is not useful. For such loss-making companies, investors may need to adopt different valuation metric like the net tangible asset or liquidation value to determine the underlying intrinsic value of the company. That is, of course, if you're confident that the company will turn around. Hence, this shows that the PE ratio is not the absolute best valuation metric when evaluating companies, as there are its limitations too. What's paramount is having a variety of valuation metrics that are relevant based on the company's business model and industry. For example, the net tangible asset or NTA for distressed companies, price to operating cash flow or free cash flow, which is to measure the company's value based on its cash flow, dividend yield, and even discounted cash flow, and not solely rely on PE ratio. Myth number 3. Blue chip stocks are the safest. Popular among the mass is the belief that blue chips are safer or more conservative. Blue chip stocks are associated as being high quality stocks with stable earnings, no extensive liabilities, and consistent in paying dividends. Sounds like the perfect asset class, right? However, this is a dangerous misconception. Let's explore why. Stable earnings today or in the past does not necessarily mean that earnings will continue to be stable into the future. Earnings largely depend on consumer and economic trends. No extensive liabilities does not mean large business risks are not being taken. Business decisions that introduce large risks usually do not make it into the balance sheet until it is too late. A company that pays dividend does not mean they will continue to do so. We have seen many companies who eliminated their dividends as they could not pay them out of their cash flow. To give you some examples, Sapura Energy, Jobstreet, and Star Media are once worshipped as blue chip stocks. Unfortunately, the management did not manage to sustain their business growth and innovate to adapt to changes in trend, which resulted their business and share price to deteriorate massively over the years. Clearly, being considered a blue chip stock or company means very little. We should also remember that all great companies were once small startups. When investing, investors should stick to companies they know and whose businesses they understand. The management of those companies should be honest, open, have a sizable ownership stake in the company, focus on creating long-term shareholder value, and should not display behavior consistent with the institutional imperative. The CEOs leading the company should also display taking personal responsibility for both positive and negative results. These qualities are much more important than being labeled a blue chip stock. The last myth, myth number 4, which is HODL, or what we call it as hold on for dear life, or basically hold forever. Many investors will fondly remember the 1990s, 2008, and definitely vividly in 2020, when nearly everything they bought rose in value amid a stock market bubble. As we have learned from the different crises and the subsequent recession, markets go up, they go down, and then they go back up again. If you just buy and hold stocks, you won't be able to profit from changing economic conditions or sector-specific situations. Don't confuse buy and hold with investing for the long term. This is not market timing, but rather a regular evaluation of your holdings. Look at your portfolio and ask, is the valuation still alright? Is the market overheating? When markets take a tumble as they did in 1998, 2008 and even 2020, look at your investments and decide if the reason that compelled me to buy this investment today still apply. If they do, then hang on. But remember that over time, those reasons may not continue to hold. Say you bought something that was undervalued but the stock price and valuation rose dramatically in a year. Buy and hold investors would hang on, but the savvy investor should be thinking about selling some shares instead. Global events like a major market sell-off could also create attractive buying opportunities. If you take a hands-off approach to investing, then you have missed out on a chance to buy shares at a massive discounts during the recession. Don't get too excited though. You don't want to be the frequent trader either. It's never all in, 𝐒𝐔𝐁𝐒 or all out, but gradualism is the best. So those are the 4 investing myths you should take note in order to survive in the stock market chaos. Thank you for sticking to the end. I hope you guys learned something from this video. If you did, make sure to hit the like and subscribe button. I've noticed that 90% of the viewers that have watched my videos have yet to subscribe. If you have not subscribed already, I would appreciate if you guys can gently tap on the subscribe button because it motivates me to post more contents like this in the future. With that said, I'll see you in the next one.